We already know that the top line of the P&L is one of the most important elements. The amount of sales a company makes is a measure of how large its business is, and how the business performed in comparison to previous periods. Did the business grow? Did it grow faster than the rest of the companies in the industry? Is the business slowing down and entering a phase of decline? How likely is it that this performance will continue in the future? These are some of the critical questions that investors will ask before buying a company's shares. Therefore, financial authorities must ensure that all companies report their revenues in a consistent and unbiased manner. They have to be certain that all companies respect a certain set of rules that impedes them from recognizing revenue earlier or later. One could rightly ask, hey, but why would a company want to recognize its revenues earlier rather than later? Isn't it the same? At the end of the day, this is the money that is going in its bank account, so what difference does it make if we record the revenue in December 2016 or in January 2017? Well, it makes a huge difference. If we record the revenues in December 2016, this will boost the company's revenues for the current year. By doing that, we automatically improve the comparison with last year. The firm's business will appear to be in much better shape. This is why the company's management could be tempted to recognize revenues earlier rather than later. Entities like the Financial Accounting Standards Board and the International Accounting Standards Board are well aware of this issue and have created a set of rigid rules to ensure proper revenue recognition. According to the FASB, revenue is recognized in the income statement when it is realized or realizable and earned. In order to clarify this definition, the Securities and Exchange Commission in the U.S. provides the following guidelines. Revenue should be recognized when there is evidence of an arrangement between the buyer and the seller, the product has been delivered or the service has been rendered, the price is determined or is determinable, the seller is reasonably sure of collecting money. These are the criteria that need to be satisfied in order to book revenues in a given period.